Hi everyone, Jeff Yasteen here. Make sure to subscribe to our YouTube channel and to follow me on social media, Twitter @Jeff Yasteen, as well as on Facebook with Jeff Yasteen 1. Well, I wanted to bring your attention to what could be an important development for both the stock and bond markets. And I want to give you a stock to watch, as it turns out to be a correct call. I'm going to go out on a limb here, but I say could be because, like all price trends, there's no way to know if it's really going to pan out or not until the trend itself is fully established, and that's where the risk comes in the stock market. So I could be wrong. On the other hand, if I'm right, it could mean big changes are ahead in which stocks are going to go up the most in the months and years ahead. And it could mean a whole different set of winners and losers. And I'll tell you which sector could be a huge winner. And I'll give you a little hint and say this: maybe Warren Buffett was right once again. I've circled it on this chart of an ETF, an exchange traded fund. This is the iShares 20-year Treasury bond ETF. Now, what we could be seeing here is a double top formation in bond prices. Now, what's the big deal about that? Well, lots of important price trends have tended to come to an end, either temporary or long-term, with classic double top formations like this one. For instance, in 2018, just around the beginning of October that year, Amazon's stock chart showed a nice double top formation here just before the stock fell 30% into the last quarter of that year. Likewise, the NASDAQ had a classic double top in 2000, and that occurred just before the index ultimately fell 70% over the next 3 years. Now, it's important to note that double top formations do not predict anything. Sometimes they turn out to mean something, sometimes they don't. And the stock or index in question moves higher anyway. But to me, seeing double tops is sort of like seeing a caution sign on the highway. It's a reminder that road conditions, or in our case, market or stock conditions, might be about to change and that we should pay attention. So that's why I'm bringing this to your attention today. So here's the thing to remember: bond prices and interest rates move in opposite directions. If you're new to the stock market, you're new to investing, say that to yourself 3 times over so you'll remember it. I mean, bond prices and interest rates move in opposite directions. So if bond prices are topping, if they're going down, what does that mean for interest rates? It means that interest rates could be headed higher. Now, if you're under the age of, say, 30, higher interest rates may not be a big deal. But maybe this chart, which is showing us the interest rate paid on the 10-year Treasury note, might change your mind on this. It is showing us the interest rate paid by the US 10-year Treasury note. Wall Street calls it the benchmark bond, and for good reason, because everyone watches this chart. And if you look back here to the early 1980s and late 1970s, you can see where interest rates, and we can see it right over here, 15%, 16%, that was the top in interest rates back then. That's how much, if you were getting a loan, somewhere around there was what you were paying back in that time frame. And as you can see, ever since then, what's been happening? Interest rates have gotten lower and lower. In the 90s, they're around 7, 8%. And in the first decade of this century, basically 4, 5, 6%. And now here we are down where the US 10-year Treasury is paying less than 1%. It's paying 0.7% annually for the US government to borrow your money. And again, credit cards, loans, everything in terms of money that you might want to borrow is based somehow or another off of this particular chart. So that's why this could be a big deal to all stock investors. It means that businesses that earn more profit when interest rates go up do better. And that's the place where you want to start focusing some of your attention in terms of looking for stocks to buy. For instance, banks, right? Banks do better because they can charge a higher interest rate on their loans and their credit products. It's basically permission for banks to raise prices. They're raising prices on the cost of borrowing money. And we can see the relationship if we put a chart of the same iShares 20-year Treasury bond ETF bond prices that I showed you earlier, and then compare it in the orange line here against the S&P Bank ETF. The symbol is KBE. Notice the relationship? As one is going up, the other is going down. As this one goes up, the bank ETF goes down. Now the two have switched places yet again. And that shows you where there is this one-for-one environment, at least over the short term, regarding interest rates and bank stock prices. And we can see the same relationship if we put a chart of a big insurance company like Allstate, that's in the orange line here at the bottom, up against the same iShares 20-year Treasury chart of bond prices. Notice again, these two are like mirror images of each other. As Allstate's stock price goes up, what's happening here? Bond prices are going down and vice versa. So likewise, this is where I have to wonder if Warren Buffett is once again making the kind of big, accurate bet that he's famous for and has earned him a huge fortune of more than $140, $150 billion, whatever it is these days. You may recall the headlines in recent weeks that he's put even more of his money into shares of Bank of America stock. Now, most observers thought that he was buying more Bank of America shares because he was seeking stability amid the economic and market uncertainty of the pandemic. But I have to wonder now if Buffett, as usual, is thinking two steps ahead of everyone else, betting that the actions of the Federal Reserve, Congress, the Trump administration, along with the same measures being done by central banks and governments all around the globe, that may be the final straw to shift the trend that we've seen for the last 40 years now, from low and lower interest rates and a general lack of inflation to higher interest rates and higher inflation expectations in the years to come. And I have to tell you, it's intriguing to see what's starting to happen with some individual bank and insurance stocks in the last number of days. It's still early. We can't say that there's been a specific change in trend. They're not exactly breaking out. They're not exactly moving higher just yet. But if we look at a stock like Aflac, which I really like at this point, you know all about this company because you've seen the commercials on TV. But as a stock, it's done well for years. And just looking at this particular pattern here, where it fell sharply and all the panic selling from the pandemic news, basically between mid-February and roughly mid-March or so. And since then, it's basically done what? It's been moving sideways. It hasn't broken out, but it hasn't started to decline either. And I like where things are on this stock, and especially if interest rates are having a specific change in direction, which I think is likely the case. So as a stock, it's done fairly well for many years. I mean, it's been a key holding. It pays right now a dividend of around 2% or so. But if you look just what's happened since the pandemic sell-off, it's basically trading at the same price that it did a little over 3 years ago. And if we go to a longer time frame, again, you can see the stock has been a very, very good performer for many years. But you can see really since the financial crisis, the top was 32, and what's the stock trading at now? 38. So if you sidestep the question of dividends, which is where you're getting a bigger payout over times like this where the stock is going sideways, but in the meantime, you're collecting dividends. But at this point, I have to wonder if we're not going to start seeing a change in trend in Aflac stock and start seeing it begin to move higher as I kind of zoom in. And again, each of these bars is basically 1 week's worth of prices for this stock. And I think that is quite possibly what we are looking at here with interest rates, and therefore insurance companies and bank stocks might very well be a great place, an unexpected place for so many people to start looking for more performance in the weeks, months, quarters, and years ahead. If you like what I'm talking about, make sure to follow me on social media and subscribe to our YouTube channel. I'm Jeff Yasteen.